So there are many who want to take retail to the next step, right? We want to evolve retail. We want to make it more integrated with e-commerce. But then there's a lot of people in the real estate world, to be frank with you, who are doubling down on the past. And the question is, why is that happening? And I believe a big reason why it's happening is because people just don't know how do you get a digital native brand to lease space from you. So that's what we're going to dig in here today. How to lease physical retail in the post e-commerce world. Sounds like a very exciting title. And we'll start out over here just talking about the general challenges. So I think, from my perspective, I think, cautious incumbent retail has been slow to innovate. So, I mean, Ryan, you come from incumbent retail. You take no responsibility for them. I get it. But ultimately, like, if you want to innovate, like if you're, for example, Macy's or Old Navy, you have systems in place. Innovating isn't just about saying like, okay, guys, what are we going to do? Yeah, we'll just do X, Y, and Z. Boom, as if you have no infrastructure in place. There's a lot of infrastructure in place, no?
There's a lot of infrastructure in place. I think the real sort of central issue is that the cornerstone of these businesses, and let's just call them what they are, they're large enterprise scale businesses. And traditionally, across lots of different verticals and industries, innovation is really hard to come by when you're a big company. It is. Now, I'm not trying to say that's an absolute rule. There's certainly companies of larger scale that have done that. But when you think about just the general enterprise, innovation's tough if you're an incumbent business and you're a large business.
Yeah, and I think online retail has been a huge hit, right? But Amazon loses in every order, right? They make it up in other businesses, right? So pure play online retail, and that this is a very important thing to denote. And Ryan brought that up to me. Like, we're not saying online retail doesn't work. Online retail is just it's another way of retailing. But pure play online retail, meaning you don't complement it with any stores, is a tremendous issue, and it has not been profitable in any way. And um, Jessica, I'm curious your thoughts. Like, incumbent retailers have contracted and closed. Obviously, on a daily basis, you're leasing retail with retailers, and you talk to these retailers on a daily basis, and the contracting, the closing. What's the conversation behind the scenes?
Well, the conversation behind the scenes with the retailers, I mean, and this isn't even to the digitally native brands necessarily, because those aren't the guys that I deal with on the day to day. The retail that's really grown over the course of the last 18 months to 2 years, call it, has been your almost your service-based and non-traditional retail. So think urgent care, think your services such as data, right? So cell phone
Hmm.
orders, your Comcast of the world, those types of tenants. And they've been kind of dominating where deal points make in markets because that's the big credit we go after. And landlords are still, and institutional landlords at that, are still looking at the traditional metrics of qualifying tenants. And that is, how big is this company and how strong is their guarantee, whether or not they have a good following, whether or not they're present in the market, whether or not they have this sexiness that digitally native brands bring to the scene and the foot traffic that a digitally native would bring to the scene versus a Comcast. It's going to be the same foot traffic. They're going to go there for the same thing every single time. They're going to walk out with whatever it is they need, whether it's a cell phone or their cable box, and they're going to go home and finish their day. This continued plight towards traditional retail hasn't opened the doors to the value behind these other brands yet.
Yeah, and I think, Rebecca, I think you've sort of been on the forefront of dealing with these digital native brands and online brands, growing into retail, but they haven't established themselves yet in retail.
Right. Right. So here's the interesting thing that's been happening actually very recently with a couple of brands that I'm working with is they're, trying to now grow up a little and sign what in their minds, and not in traditional terms, but in their minds are long-term leases. And long-term leases to these brands are 2 years. Okay. Not 10, right? They're 2, and that's like terrifying. But they've kind of gotten a confirmation, whether it's through doing pop-ups or, some other opportunities where they've confirmed enough for themselves, these D2C brands, that yes, retail works for us. So we want to now take this leap And, you know, the landlords are going, well, do you have a store in New York? And actually, a lot of them are opting to not open stores in New York and not open stores in LA at this juncture because, and I've been saying this for the last year and a half, those areas have not returned to the foot traffic that they would like to see from a critical mass standpoint. And so what's happening is like they're trying to go into key areas in the South, Miami, Texas, you know, like different Austin, wherever. And the landlords are like, but we don't see you. But these brands have like millions of followers on social media. They have, you know, what I'm going to call reasonably robust e-commerce businesses, right? Like nothing to sneeze at. Like certainly in the millions plus, you know, like of dollars of e-commerce sales. But because they don't have like a flagship in New York, the landlords now won't talk to them. I don't get. And that's happened a couple of times very recently. It's been very surprising to me.
Yeah, and I think real estate is a very revenue-driven or income-driven business, and bankable income, of course. And you know, as they say, you know, very often you hear over the years that my shopping center is worth less because Main and Main moved 6 miles to the right. Well, Main and Main doesn't get up and move. Main and Main grows out of somebody moving, whether it's historically a Walmart moving locations, or it's just, you know, somebody built houses there, or whatever it is. And one of the ways to basically allow Main and Main to move is not to be proactive in merchandising a shopping center. And there has to be a better way to sort of assess these retails, how to get it done. So I want to dig down, and there's a lot of information on this slide, and all you guys can see this slide, but let's just talk a little bit about what's a digital native vertical brand or a direct to consumer brand. Okay, now let's be real. An e-commerce brand is any brand that is online, right? And just because you e-commerce doesn't mean it can't be in store. But a digital native vertical brand, a DTC brand, they're usually brands that are born online, they sell and they ship their own product. It isn't just e-commerce, it also self-manages an entire process. So basically, Shlomo Chop wakes up one day and says, I got a great idea for a sneaker. Oh, we're going to be great. So I find a manufacturer, I manufacture it. Then I spend a lot of money in advertising. I basically make Facebook's quarter, and I put the information up, and people go and they buy from me. And what do? Then I package it up and I send it out, right? So that's what happens first. There's a few different things that we could tackle. I'll take a couple of things over here. The first thing is asset and infrastructure light, right? These guys, it starts out in a garage, right? And, you know, Bill Gates started in his garage, right? But Bill Gates wasn't carrying stock necessarily, and Bill Gates had the code, right? But if you have a lot of product, like you're literally storing it in a garage, you're having someone could pick it up, you're not necessarily beginning it profitable, even if you may have a huge amount of followers online, it's irrelevant, right? And I think, and you know, the second thing is that the founders are product and marketing experts, right? These guys that go in, like there's, you know, I don't know, a pan and a pot company. This guy, I don't know, but more than likely, these guys are not that they worked forever at, you know, Farberware and said, I got a great idea for a pot and a pan. It's somebody that came up with the concept on their own, or has a marketing background, or maybe these two founders that joined, they made it happen. And they go over to a VC, and a venture capitalist gives them money. And the focus is brand above else and top line growth focused. Ryan, can you talk about like why, when they go into the venture capital, we've spoken about this a bit, why is it about top line growth focus? And then if you could talk about a couple of these other things, including brand and above all else, because the VCs, and correct me if I'm wrong, they know they're not going to be profitable initially. It's not about profitability, is it?
Well, you know, Ryan answers that. Can we ask Shlomo why it always comes back to shoes? Is there something about shoes we should like? Yeah. Can we get your shoe closet? Like, what? Why? Like,
shoe closet post.
Like what?
I don't have a shoe closet post.
Shlomo, I'm going to advise you not to show your shoes right now. Just stop.
No, I will not pick up my foot and show.
Is it just me, or is there always a shoe story in every retail that we do?
It's just. Right, that story with the container of shoes that the guy sold at the retail store, and he found it was all left shoes. He said, "Is this for dealing and not for selling?" Yeah. What can I tell you? I mean, unfortunately, the guy that they said the story about, unfortunately, just passed away.
You have like a deep-seated shoe issue.
I got a shoe issue. Yeah, we could honestly, and you know, when we have our get-togethers, we could actually tackle the shoe issue.
Well,
But these shoes
that
are
was
meant for
my-
walking, that's for sure.
Yes.
Okay,
All right.
let me try to rewind from about Shlomo's shoe issue. So Ryan, talk to me about talk to me about
with a straight face. Can I just say the first thing to say is like, look, we're not going to go into a differing definition as to what DTC is versus DNVB. We will just lump them together for all intents and purposes and just say a commercial intent to service customers with a value proposition, product or need through digital mediums. Let's keep it very simple here. I think to your specific question about venture capital and funding it, the real answer here is that you have to partition this out in segments of time. So for example, when there were minimal to no barriers to entry to get into the ad market, let's say 8 to 10 years ago, the costs were incredibly favorable and it was incredibly scalable. Yes, throw money at it, invest in it, grow. It was, viable, right? You could acquire customers. You had either break even to positive transactions levied against your acquisition costs. And it was a beautiful time, right? Well, in that time, yes. I would say though, for venture consumer investments in the last 4 years in particular, they've become a lot more prescriptive about that model. Essentially, what are you paying to drive traffic and generate sales? And the good ones that show promise will get investment. And of course, the obvious one is for those that aren't, won't. But it still doesn't necessarily sort of like answer the question as to why were we just so slow to sort of reconcile the fact that commerce actually needs to sort of exist in a more universal element, that people may want to go buy something from a store. They may see your brand and discover your brand there. It may be convenient, the utility of your product, to just buy it on your phone. But ultimately, customers aren't really going to value the idea of picking and choosing. They just want the simplest, fastest, easiest thing. My little simple soliloquy here is that they just simply want to buy what they want, when they want, how they want, where they want. As simple as that.
So it's essentially the digital native brands. When they start out in the first few years, as I understand it, they're gathering customers, they're gathering people they can eventually remarket to. They're gathering market share, and they get the valuations based on market share, not necessarily based on profitability. On the other hand, if I'm a landlord, I'm like, how profitable are you? What have you done? Where's it going? And I don't want to take that risk. I mean, Rebecca, is that what you're seeing? And Jessica,
I mean, I'll let Jessica talk about the real estate side, but on kind of the brand side, there's definitely a tension, right? Because there is still in order to get funding, VC, private equity, whatever it is, they still are looking at top line sales. So there's still this dissonance between, gross revenue, net profit, and that has to reconcile at some point, because you're right. When they go out to get real estate, generally speaking, they want to know where are they established, right? And we kind of talked about that earlier, but also, how much are you making? But to the brands, they're getting pressure from their investors, not necessarily to have profit, but to have sales. So, there's definitely a tension there that still exists.
yeah. And I think, Jessica, I mean, if I'm a digital native brand, I want TIs, meaning I want the landlord to build out some space, and I show up and like, well, I don't really have any track record. I'm giving you a 2-year deal, but there's no way I'm taking that former.
Yeah, you're taking a warm shell. I mean, you're looking for a shell that's already specifically been built out for retail, right? And it can be a simple shell, right? I'm sure, Rebecca, you've got clients that would happily take a new shell with just concrete floors, drywall walls, and simple bathroom in the back. I don't think that these brands are looking for over improvements, but they certainly are looking for improved spaces that are clean of any previous tenants' fixtures or rent.
No drop ceilings, hold on, just no drop ceilings with water stains on.
Exactly.
Right.
So where I really see these brands being able to jump into the market is in some of the new construction. If you look at the new construction that's been dropped, say, into the Oakland market, the Berkeley market, and I'm talking just Bay Area here because that's my geographic region, but you look at the amount of excess shelf space there is out there. These landlords are missing a huge opportunity. These are densely populated areas. And if they were to build out these spaces just a little bit, they could probably create an area where digitally native brands want to exist. But instead, they're chasing other deals because they're sexier, they are well-known names, or they have a balance sheet they prefer more. But instead, they've been sitting on excess vacancy. And I know that this runs through other metro markets as well, because we did have a huge delivery of mixed use retail residential space through 2018, 19, and 20, and has not been absorbed yet. So I think that this is something that be applicable to a lot of markets if we had a little bit of head pickup in terms of what the dynamics truly are behind leasing and what is truly credit worthy. Is it just a balance sheet, or is it how much traffic is being driven and the activation of your site?
Yeah. And not to get too far in the weeds, Jessica, but that's such a good point about the space conditions, because a lot of these brands, when they're willing to make the jump to, again, long-term in their minds, 2 years, leases, they've likely been doing some sort of cascading pop-up to test, and it's been a 6-month, sometimes 8-month opportunity, and they're walking into second-gen spaces. Sometimes it's not fully debranded from the previous brand. So I think if they walk in and there's like no lights in the ceiling and exposed electrical, that's a little scary to them. So if the landlords would just like finish things a little bit, that would be far, far less scary. And they would feel like, oh, we can totally do this.
Yeah. Yeah. And I think that there's definitely room for landlords. But again, as you're talking about, there's this friction between brands and investors. There's still friction between owners and landlords and even their own investors, because in all reality, a developer who's actually managing a property that's on the ground may not be the person at the end of the day that they're actually reporting to, because they had money that came from wherever else. So they want to know why the space isn't leased, or why they're not seeing certain brands or a certain amount of absorption within a project at a certain time. So you've got the same forces happening on the landlord, on the real estate side, as you do on the brand side. And so this is where you need to have like this sit down meeting with everybody at the same table of like, okay, you guys, here's what we're gonna do.
We have a sit down.
Can we all just talk? Can we just talk about this?
We have a sit down, at the local restaurant.
You need tenants and we need space. Let me tell you, I got something.
Exactly. Please, don't make it so hard.
But so here's the interesting thing. Okay, here's the interesting thing, right? You have shopping centers that have vacancy. You have digital natives that want to go into retail. But here's the problem. Okay, landlords want digital natives, but they don't want what digital natives bring to the table. They don't want their
terms. They don't want their 2-year deal.
It's like being engaged to a mentally unstable person, right? She's so good looking, but oh my God, does she make your life a living hell, right? It's like you want what you can have, but you really don't want it. When push comes to shove, you're like, forget it, I can't do it, right? And on both sides, neither party knows what's going on with the other. And I think one of the biggest challenges is knowledge, right? And something I've seen even in the brokerage community, I don't know that they know some of the things we're about to dig in on as it relates to digital natives, right? You talk about like last mile fulfillment. Okay, who's going to do last mile fulfillment, right? Who's going to, last mile fulfillment, or there was news yesterday. KKR is developing warehouses just as Amazon is decreasing it, right? So someone posted online, a buddy of mine, he's probably going to be here, and he's probably going to call me out. And he's like, well, there's massive demand. What do you expect? Yeah, there's demand, but these are 10-year investments, right? It doesn't make a difference. No one has to dig too deep. If you get the financing, we're going to put it up there, right? You give a developer $1, he's going to build just the way it is. So there's a whole different way of thinking about it. So what we're going to try to do over here, and guys, please throw questions at us, because we're going to run out of slides eventually, and we need something to talk about. So if anything, it could be about Jessica's shoes and Rebecca's Harry Potter, or about anything else about bad relationships we could dig into as well, right? But we're going to dig in over here to some of the challenges. So when you negotiate with the other party, you sort of need to understand, right? Think about it, right? It's the oldest story in the book. You want to buy a shopping center site to develop something on it. The guy won't sell. What do? Hold on. The grandfather owned the current property. They don't want to release the grandfather's legacy and give it to you to build something. You say, okay, we'll name it after the grandfather. It will be John Graham Shopping Center. Oh, all of a sudden things start, backing up. Real estate's always been creative in structuring deals. So you need to understand what's happening on the other side, how we structure deals around it. With that, we're going to dig in over here. Let's talk about 3 major issues that digital natives or pure play e-commerce have. Number 1, acquisition costs. Number 2, shipping costs. Number 3, return costs. Okay. Let me illustrate it to you. I wrote it out, but I'm going to read through it. I'm going to talk you guys through it. So digital native brand, let's call it Tuck It In, sells $100 shirt. Okay, I'm sorry. Sells $100 shirt. Let's assume he's a 50% gross margin on that, right? It cost him total $50, landed in the US, boom, $50. Okay. Now they just made $50. Meanwhile, they advertise on Facebook, on Instagram, and they spent $100 until Jessica. This is a shirt, by the way. It's not shoes. Can I just point that out for the record? Okay, thank you.
That's really good.
Yeah. So someone goes and finally clicks buy, and they buy it. They buy the shirt after spending $100 on advertisement. First, they go and they spend on Instagram, then on Facebook, then sending emails, then texting them, whatever it is. He finally says, I'm in, I'll buy it. Okay. So when they did this, they say to themselves, we're going to spend $100 because we're going to get $300 to $400 worth of business over time from him, which, or profit, whatever the numbers are. The numbers don't make sense. I see this math over here ain't going to make sense either way. Okay. And the cost is going to be a pick and pack cost of about $1.75 and shipping of $12, right? So basically, it's going to cost them $1.75 to pay the local place to take it off the shelf and $12 to ship it to the person. If the customer doesn't like the shirt that they get, because they never had a chance to touch or feel, they saw a picture online. The picture online was taken with the best lighting. Picture online was taken on a model, right? And it's all a perfect picture, right? They have to return it. They have to pay another $12 for return shipping, another $2.50 to process it, assuming it's returned in good conditions. Here's what happens. You spent $128.25 on a sale that never happened. You know what else? They didn't even have the chance to go into your store and exchange it. That's what digital natives are struggling with, okay? They can end up, and there's no, who knows, they may not come again to shop at you. Now, Ryan is about to beat me up on something. What?
No, Shlomo, I'm just trying to process all the mental gymnastics you were throwing at us. Like, I was thinking Mary Lou Retton. I was literally just going through. I'm like minus 2.5, and then the world sort of came to an end. I mean,
bottom line here is a very simple equation. If you pay to get someone to buy something for you and he doesn't like it and he sends it back and charges you to send it back to you, you just spent a lot of money, got nothing out of it.
I mean, returns are poopy. Let's be honest. Like, nobody likes a return in a store online.
Yeah, but if you go to the store,
it's certainly more of a cost burden.
You still have a chance if you go to the store. I mean,
yeah, if you go to the store, you're like, sir, can I please show you what else we have, right? Okay, I'm going to talk about shoes.
Right, like,
sorry, I bought shoes online. The size didn't fit, so I bought a different pair of shoes. And at the different size, it came and it was fitted a different way, right? Thank God this place had a store, so I was able to walk in and all our shoes are sized differently. A very well-known shoe company, but it's weird, right? It's what happens? Yes, I know shoes are a real problem. I'm noticing it, guys. I'm sorry. It's finally hitting me. I got it. I'm going to see a therapist after this.
Thank you.
So, yes.
Sure.
Okay. Not that it's going to help, by the way.
No.
But
I think there's an important, serious point for brokers to think about if you are engaging or when you are engaging with these types of potential clients, is that there's a big headwind. Acquisition costs, even pre-pandemic, had gone up over 50% in the preceding 48 months. And today, that number, I don't know what the exact number is, but it's even uglier, right? It's incredibly more challenging. Privacy issues that they're facing are here to stay. I think we've kind of beat that one to a pulp over the last 6 to 12 months. But when you think about a retail endeavor, the acquisition costs and costs of doing business is favorable to the extent that you can simultaneously expose your brand and your product and equally generate sales and profit. This is sort of a standard hallmark of that retail channel. It is not a business where you open up a shop and then you have to spend another $250,000 to drive people to come into it to optimize your whole kind of conversion funnel. You literally are there in an environment that may have 1 million footsteps a year. So you get a lot of visibility, you have a lot of traffic, and you get to introduce and let people engage with your brand. And that brand has the ability to do it profitably. And secondly, I would say this, in light of a lot of the headwinds that digital native brands have faced and are increasingly facing, they are more open-minded about optimizing their marketing channels and thinking about new ways to connect to customers than I have ever seen before. And I'm sure Rebecca may have similar thoughts on this as well.
Yeah, I mean, it's such a good point. I think you hit on something that I was going to bring up anyway. And it's, yes, there's all of this, cost of returns and yada yada and all of that. But there's also the cost of like that brand affinity that doesn't get built. That if you walk into a store, even if you, let's say you buy something, you take it home, you try it on again, it's that like, you know, you wanted that dopamine rush to buy something, but then you go home and you decide you don't like it. This has happened to me. I don't know if anyone else does this. And then you take it back. You still could have a connection with that brand and then end up purchasing from them at a point in the future. Whereas if you're just getting something online, it doesn't fit. I even exchanged it once, like your shoe story Shlomo, except let's pretend they don't have a store. So now you're just like going to write off that brand forever. Right. So I think that is a big problem. On your point, Ryan, to, you know, kind of the new, I guess, levers that brands are using, more brands than I've ever seen before are interested in clienteling, personalized customer outreach. I mean, this used to be reserved for like Coach and Louis Vuitton, and like you didn't talk about clienteling unless you were up in that high luxury market. Now we're talking about just like basically everyone, like everyone, athleisure, shoes again, you know, like accessories. That whole personalized relationship is something that, you know, is easier established through that store face-to-face interaction, because you have that person that you identify with the brand as a customer. Like I know Sally and she's my go-to person. Every time I need a new pair of leggings, I'm just going to text Sally and say, what do you got for me? So, you know, I think it's a good point.
So, Jessica, I'm going to throw this to you because you know there's about, I don't know how many people are watching, but there's about 5 developers or brokers that are watching right now. They're saying to themselves, aha, you see, they should want to come into retail. This is obvious. I mean, like the ICSC is done, unfortunately. Yeah, they should want to look at this. It's a problem. Come lease from us.
Yep.
It's not that simple, is it?
No. Again, we have this friction that continues to exist between the deal terms of what these brands are able and capable of signing versus what landlords' traditional expectations are within leasing. And so until we're able to have more open-minded conversation of this is a 2-year deal, maybe there's not a whole lot of TI, but we're going to deliver a clean box. So it's not a vanilla shell, it's an improved box. It has HVAC where necessary, depending on the region. It has your lights, your sub panel. You've got your floors in there, probably just concrete, something standard, until we can get to that point where people are comfortable, landlords comfortable underwriting deals on limited credit basis and limited term basis. We're going to continue to see this friction point. And so I think in order to really address it, it has to be addressed from the very beginning of underwriting as these properties are coming out of the ground, because then you can pro forma for shorter term deals, and that gets written into your overall finance of the deal. The problem is you can't get down the road. You've now delivered, you've got some vacancy, and you're scratching your head. Now you get this 2-year deal, but the numbers don't work because you need to throw $110 at a cold shell space to only get 2 years. Well, it doesn't work like that. Those numbers won't ever work. They simply won't. But if we can start this process better pre-construction and build out particular spaces that are specifically for digitally native brands, you can change the conversation. But it's going to have to start in the beginning of the process, not a backfill later, which is, I think, where we're misstepping this whole conversation. Is we're trying to do this after the fact.
Yeah, but even Jessica, I have to disagree with you. Office has got spec suites all the time.
Yeah,
Office build out spec suites all the time, right?
Yeah,
So you shouldn't
digitally native. But retail hasn't. That's never been a retail thing. Retail's always been so specific to the particular user who leases that space. We don't know if it's going to be a restaurant. We don't know if it's going to be general retail. We don't know if it's going to be quick serve.
Good point.
So the approach has always been in retail is hands off. Hence why it's all triple net leases. It's hands off. You're just going to pay your pass through, right? So there's huge differences between office leasing, industrial leasing, and retail leasing. And hopefully the brokers who are watching all know this, because that's kind of a big deal. And so understanding the traditional route of retail has always been tenants are specific. They have specific build outs and specific needs. This isn't your average law firm who needs 6 privates and a cube open area and 2, conference rooms. This isn't, retail's never been in a box in a bubble and it lives right here and we can just add an office. That isn't where we exist. What also is so different about every retail center that you don't run into in, say, an office building, is that we have tenant mix, and we have to work within tenant mix. And tenant mix per project can be extremely different. And where we spend as brokers on the retail side, we spend a lot of time analyzing what is the void in this shopping center, because we can't go lease to another law firm or another dentist or another. In office, you don't have that constraint. You don't have that issue. We do in retail. So every shopping center isn't made for digitally native brands. We all know that there's not enough traffic. It just isn't right. But we also need to identify where we can have these brands exist and start from the beginning, because backfilling isn't really working, at least in the way we're trying to do it now, or have been trying to do it.
It's very.
So I have a question. So in your mind, does tenant scarcity, and let's just define that, clearly, if there's just not enough tenants and you have vacancy, yes, but also you're alluding to the type of tenants, like there's just only so many dentists and children dentists and law firms you can put in there. Tenant scarcity, is there at some point in the future whereby the funding model changes?
So traditionally we haven't, right? I mean, here we go. And you're seeing malls evaporate. I think if anything, tenant scarcity might be on the upswing rather than the downswing, because we are eliminating so much retail product out there, which by all means, I'm all for crappy retail being eliminated from the market. We don't need that inventory, right? So I honestly think we're going to see an upswing versus a downswing. I don't think we're going to.
Jessica, we can't say the word crappy retail or eliminating from the market.
There is crappy retail.
You didn't get the memo?
There is some crappy retail out there.
No. This matters so much to these brands because they all know where else their customer shops.
Yeah.
Right? Like they know, oh, my customer buys my product, but they also shop at Tory Burch and they also shop at, whatever other place like Allbirds. They also shop at Lululemon. And so when they go and look at like, they're not used to looking at, kind of like canvassing
they're not looking
information
at
packets.
They're not looking at like, grocery shopping centers in suburban areas. Yeah. They're looking to play off of existing name brand retail that they can pick up on the foot traffic from. And so I think there's two ways you can kind of skin the cat, so to say, in this one. Either you're the owner who sits across the street from these brands and you're going, how do I make my rent roll look prettier? What do I do here? You have an opportunity if you do own the pad that's sitting outside of the institutionally owned Saks or whatever it is, right? Like name the brand. If you're the owner of that real estate and you're one block off or one street away or adjacent to, you're sitting great. You are the guy or gal who can use this opportunity to your best advantage. The other way to go about it is when, again, we go to the pre-construction exercises here and we know we have something coming out of the ground and we know it's in a dense area where maybe we can attract or we are close to these brands. That's where you can, from the beginning, say, this is going to be a hub for digitally native brands. And as a landlord, your almost development can be based around, especially if you're multifamily. If you've got resi above and ground floor retail, and you want great tenants that aren't going to shake the place at 11 o'clock at night with their like loud music and the bar going off, this is where those landlords should be really utilizing every opportunity they have to build in and create the hub for digitally native brands. But it, again, has to be written into the long-term projections that you are going to have turnover every couple of years. And that's okay, so long as you can continue to backfill those. And obviously, digitally native brands are not going anywhere. They're here to stay. This is the future of retail. People are going to continue to shop on this. And if anything, people are going to stop shopping through the Amazon for certain brands and things such as clothes and shoes, because it isn't an environment that feels good. You don't get that effect from it. You don't get the warm and fuzzies. You don't have the relationship, and the experience is just completely different. And so this is, again, where I think there are so many landlords that have the opportunity to build off of what's happening, but it has to be done on the front side for their own underwriting purposes and for their own performance. It's much harder to try and do on the back end.
Yeah, and I would argue I would argue that,
Of course you would.
a lot of digital natives have looked at retail. Come again? Did I
I said,
argue?
of course you would. Of
Of course,
course.
I always argue. No, but I'm agreeing with you, actually, believe it or not.
What?
So yes,
No.
100%,
You hear that?
100%.
See,
And I like your costume, by the way, Jessica. It really, really fits you. But here's the deal.
I'll paint it. It's a soft.
A lot of digital natives have looked at retail as a advertising thing. Basically, they say to themselves, okay, we don't overdo sales in retail, but we're bringing awareness, advertising, right? So they're bringing virtual foot traffic or sightlines, right? Landlords have to understand that bringing a digital native brand to your shopping center increases the excitement, because these brands that will make it off online into a shopping center will have a strong following. They may not have enough of a following to support their center, but they will continue to bring a following into your shopping center.
Yeah.
More traffic, more sales, more rent. It's just how it goes. It's a formula, right? To just basically say, like, I don't know, in World War II, if Churchill would have said, oh, wow, they invaded France, let's go and hit France tomorrow. You can't do that. You got to build up to it, right?
Yeah,
they couldn't do it.
Are you going to build a 150,000 square foot shopping center and throw a Whole Foods in the middle of it and do 80,000 square feet of digitally native brands? Absolutely not.
No.
But if you are, again, and I think where this fits in, if you are the developer who has 170 to 200 units and you have 13 to 15,000 square feet of ground floor, you're in a an urban market where you have other good retail within proximity, you got something to think about, because your retail isn't what's going to make your project successful at the end of the day. Your retail is just the tail that wags the project, right? Like that's the type of landlord who can really jump on this. I mean, and maybe to some extent, it's even some of these quasi-industrial retail buildings. You've got these 15 to 20 to 30,000 square foot buildings that are freestanding, that have great loading and warehouse to the back of them, but they do have these traditional, what may have been your appliance showroom, your spa showroom in the front, where you've got those types of spaces too. Those set up really well if they're in the right location for this type of brand as well. And again, you can create the hub up front and then have your distribution towards the back. So it's more than just new construction. I think there's certain types that will work all the way around, but it's just adapting how we've traditionally looked at deals, which is really hard to do when you have money in your back pocket that has amount to it. And that's where the real estate industry gets caught, is money has a mouth. And that's where digitally native brands are going to struggle with certain landlords.
Yeah, when you say money as a mouth, what you mean is like there's limitations as to what they could use it for.
Yeah.
And
how is it being used? Why is it being used like this? Well, why are we putting TI into this deal that we didn't think we were going to have to? Well, isn't that the tenant's responsibility? I mean, that's what happens when you've got a new construction project. It's the layers, right? It's not just one.
And even existing, if you have a CMBS loan on it,
yeah,
if you allocate money to something, your lender may have approval rights on it, and the lender may say, well, we don't want to give it that didn't work out, and then you got to educate the lender on the process. I want to dig in on a few things on this page, if you don't mind. I was at Shop Talk, and David Simon was on the stage. He was someone from Greats. And the guy I think the founder of Greats, one of the big DTC guys, and he was saying, hey, our landlord needs to market more. And the landlord said, what are you talking about? That's your problem, right? And it's like they're talking past each other. At the end of the day, this guy doesn't survive, this guy doesn't build. Funding model, right? The DMVV funding model is like, okay, we're funding you for advertising. Stores didn't enter, stores are the fallback, right? Even though stores are needed. So you could chart as many studies about halo effects, about traffic, about all these things that are great. Everyone will agree with you esoterically, theoretically, that it works. But the reality is practically, the money isn't there. How do you do it unless you just restructure the entire business? And same thing, unless you restructure the entire property, entire loan. So that's where there's the stuck. And unfortunately, these two get stuck over here, and someone has to come in and do something, and that's where there's a possibility. They don't know what they don't know, right? The old Donald Rumsfeld thing, right? Like the unknown unknowns. Picking the right location, size, build operations. I mean, Rebecca, have you ever had a digital native you worked with that had 25% of the knowledge of what they need to do in this line?
Okay,
a customer.
No, but
okay.
they some of them don't realize that. So
They don't know what they don't know.
they don't know what they don't know. It is very true.
And if you're selling them as the broker, they're like, yeah, of course we'll say that. Of course, this location is great. Or you give them some study. So I don't know, a demographic study. Like I don't know what's our clicks look like. What does our impressions look right? Resource limitations, depending on third party support. Like at DNVB, you call up one of Rebecca's clients, they're going to call Rebecca, right? Now, often they don't have someone as competent as Rebecca there, because who are they going to go to? They're not going to go to the best real estate guy. Go to the best person who they think knows real estate, because the uncle happens to be a developer, although he develops homes, single family homes. That's a whole different story. And lack of credit's also a very big issue. I mean, they can't do a traditional lease. So the question is, do you want to stick to your credit? Do you want to have a tenant, or do you want to have a tenant that basically is dying because he makes, he fills your vacancy above a specific number, takes away a co-tenancy for a certain amount of time, but long term your property is suffering? Or do you want to have something that's more excitement and maybe bite the bullet a bit, but long term you'll be okay? Last I checked, most deals are 10-year investment horizons or 5-year investment horizons, and if you're this close to a potential refinancing or a sale or issue, you're screwed anyway. So I mean, that's the situation. So $1 billion value.
Could I? Oh, sorry. Go ahead. Before you move on, I just wanted to add one comment to wrap up your last slide. If your intent is to lure digital brands, recognize on this slide a very important point. There's an abundance of uncertainty. So to the extent that you can provide certainty, a connection, a Rolodex, I already know someone to talk to over here that can help you with that. This is how other brands have done it. This is some best practices that I've seen. This is different types of structures. I think that could really help move potential digital brands further down the funnel. And I think it would make you more successful if you really focused on that.
Yes, and Ryan, the certainty is just risk mitigation, because at the end of the day, even though they are label themselves as self-proclaimed disruptors, they are risk averse in this particular arena.
Yeah, because they don't know this arena. Yeah.
Yes.
Yep.
Lots of uncertainty. And you know what? And if they can't get over that, then just serve them up a mega pint of wine, Johnny Depp style.
but here's
nothing that a good glass of wine can't cure. It's true.
A mega pint of wine.
A mega pint.
Did you say a mega pint of wine?
Did you say a mega pint? Is that like my mega pint of coffee?
That is a very large cup.
I know. It was a gift. I mean, it's
very large.
Yeah, I know. With a mega pint of wine in there, but
it's like bigger than my head.
I think they want to know if the wine was grown on a rooftop in an urban area, and therefore that's a really cool wine. But I just, one thing you said, Rebecca, about de-risking it, right? Brokers, the way you view de-risking is not the way they view de-risking. De-risking is not to say, look, that guy next door does a lot of sales. That's not going to work. De-risking is not saying, oh, we'll give you a great thing in front. They don't talk that language. You got to de-risk it in another way. And, and we'll talk about that in a bit if we get to that slide soon. But, $1 billion valuation does not, I'm sorry, I'm going to say it again for all you DTC founders are going to hate me now, and I'll lead you one day to, as we roll out our concept. I'm sorry. Please, I beg you in advance forgiveness. $1 billion valuation does not always, sometimes it does. You guys that'll deal with me always will translate to business acumen or the right hires, right? Meaning, just because you have $1 billion valuation, you're a unicorn, doesn't mean you know shit about shit, okay? It's just the way it is. And you can't assume that they will. So you sit at the table, you're like, okay, this guy's got $1 billion valuation. Let me take out a huge spreadsheet. And the guy's like, did you do that on Google Sheets? And everybody in Excel is like, oh my God, you can't actually do macros on Google Sheets. Maybe you could, guys. I don't know. Maybe I'm totally off. But the point is, that's not what they do. They've caught on, right? They're able to sell a product that have captured the imagination. They're artists. End of story. Now, the ones that are really successful are the ones that are able to be an artist and also be a business person, right? One example would be Viore, the founder, right? He comes from an audit background, right? And he was able to get his name. I'm sorry?
Are we talking like face strips? What are you talking about right now?
No. Viore.
Viore. I thought he said Viore.
No, athleisure. Viore is such an interesting case study. I love this brand, but go ahead, Shlomo. Go ahead.
Yeah, just as an example, he's done extremely well. He said a huge chunk of his sales are now actually in wholesale. He hasn't opened that many stores, okay? But this DTC has been profitable from day one. the guy who knows his finances, right? But most don't, right? And it's not going to happen. So if you even encounter one doing $200 million in sales, right? And if you just go and say, based on sales, you're doing 5 times sales, this is $1 billion valuation. Divide that by 50, he may not even have enough people to even show up in the store. And you're saying there's a great location, but ultimately he can't support a store. And oh, by the way, they don't want a store that's got shelves like CVS. They want a store that's an environment. You come in, you could do. I'm Ryan. I know you got some stories, but the point is you could do some really exciting stuff. That doesn't translate to picking stuff off the shelf, putting it, and checking out and walking out. So these are big challenges that we need to sort of, understand the other party and how to sell to them and how to, chat with them. And we're going to have one example over here in a moment. But, I've sort of beaten this slide to death. I don't know if anyone has any other thoughts on it.
I think we need to go back on one thing, because there's something very important that we were hitting on that I think the real estate folks all want to know. And that's going back to this whole risk mitigation conversation that we're talking about. So if I am trying to attract a digital brand to a shopping center or a project I'm working on, what can I provide as a broker or a landlord to help mitigate the risk and the fear that these digitally native brands have coming into a brick and mortar setting? Is there, what does that look like?
So I think, first of all, if the D2C or digitally native brand doesn't believe in the channel, there's really nothing that you can do. So let's say they've already overcome that hurdle, right? Like that is a mental hurdle, and whatever confirmation they've needed, they've received.
Yep.
So now at this point, I think it was Ryan that was talking about, providing contacts around, like, we will help you, we have this tenant coordinator that you can contact. We have, a brand that I actually literally repurposed fixtures from a previous tenant. The landlord has offered to move them into our, the new brand's place. We've kind of like fixed them up, whatever, there was an artist on staff who was really good at like painting and made them look nothing like the previous one. But like any kind of help in that way. The other thing I'll say that may or may not be very popular with this crowd that's listening, and I don't really know who else is listening, but is this idea of like, can I get out of this if this is going horribly wrong? Because that's what's in the back of their mind, is like, if this starts going really badly, do I have an out? And that's about terms, right?
Yep.
So you got to be willing to give up some of those terms and, temper them however you want and however you're comfortable. But if it's like, nope, you literally can't get out, I think that brand's walking away, even if they've confirmed that retail is for them.
Now, going back to kind of the tenant coordinator and call it tenant's availability to get to the landlord, could it be as simple as, hey, we have some preferred contractors who can help with TI. Here's some of the groups we recommend. Here's an architect that worked on this project. Could it be as simple as having a really nice vendor list that focuses in on tenant improvements that would be someone to work with?
Yeah, it could be. It kind of depends on the brand. Sometimes they won't, depending on the brand, they won't even know what to do with that list. But if you're with a brand who's done like probably several, call them pop-ups, short-term engagements, they probably know by now. I think the issue, Jessica, is that they've likely never worked with an architect before. Maybe they've worked with a GC who's like a guy with a van kind of thing, guy or gal with a van. Let's not, I've worked with some fantastic lady GCs. So like guy or gal with a van, but like they're certainly not working with
a few
Lawrence
other
or
pronouns
Chimenti,
we could get, but
right? So, they've worked with a dude, and then they've never used an architect. They've like made a sketch on a piece of paper and been like, I've actually literally received these things.
All I'm
like,
thinking is,
here's my cash wrap
video that went viral with the leprechaun sketch. It was like the Alabama leprechaun, and it was like on the news, and they held up the leprechaun. Oh, that is gonna be like Ryan's gonna go for
no,
it.
I need
the
to
Alabama
see this,
leprechaun. That's all I'm thinking of right now is the amateur sketch of the Alabama leprechaun.
I don't care if you're coming to Vegas for the first time or the.
Oh, sorry. I'm testing you right now,
Okay,
Jessica.
Ryan's like, I gotta find this now.
I've received a hand sketch of a fixture like hand drawn with like very little dimensions and materials and been like, here, can you bid this? And I'm like,
Oh, it's like, but you know what happened before you got it?
can't.
Yeah.
Rebecca could put that in CAD. Don't worry about it. Just send it to me in whatever format you have it.
No,
Rebecca,
but I know
how
someone that
important-
can. But I think so. That's kind of I don't know if
Yeah.
that was a little bit
No,
of a
no,
sidebar, but
no,
I don't know if that's
so-
helpful.
How
Yeah, but-
important is knowing the sales of the co-tenancy around you? Like if you were able to share, well, the restaurant does X amount of sales that's on the corner, or we know that the tenant next door is also in the same, genre as you, they're a clothing retailer, and they do X amount of sales per year because they're doing sales reporting. Is that information useful to these brands, or is that neither here nor there because they've built their channel already and they have an expectation of where they're going to be with or without neighbors?
Let me just, Rebecca, isn't it more about how many people actually come by on a daily basis?
So yes, so this is actually the misconception. The sales, it doesn't matter to them because they have no point of reference for like, well, how much is their average product? So it's actually more about footfall.
Okay.
And then what they'll do is they'll take that and then back into, they likely know their AOV. And we all know here in this room, and I think most people, that AOV is much higher in average order value. Sorry. Yes. Jargon is much higher in person than online. So like 1.5 to 2x, sometimes more. So then they can take that traffic number, make an assumption about the average order value, and make a reasonable assumption about conversion, right? Like there's,
so what
you can
you're
certainly
saying
do that.
At the end of the day, what really matters is, do we have the data on how many people are trafficking that particular site? That is what we can actually tie a direct correlation between to get a digitally native brand comfortable with a site.
I would also add this
and
point.
go ahead, Ryan.
No, go ahead. You had an and.
I was just, last thing, extra credit if you have anything around like demographic and psychographic information, because again, these brands know their customer.
When you say demographic data, there's obviously a lot out there. So are we talking knowing the ages,
household income?
So the standard things
like,
we see. Are you looking for, and traditionally in retail, we do 1, 3, and 5 mile rings. Is that true for digitally native brands, or has that changed because their threshold is so different because they are bringing people in who may be coming from longer distances because they are more of a destination? I mean, what is the consensus in terms of the appropriate demographic ring?
That's a good question. I haven't yet. I haven't given that too much thought because brands haven't actually asked that much. But what I will say, just based on personal experience,
we're even before the brands. We're ahead of our time.
Actually, isn't this what this conversation's all about, right? Like, I mean, I think, brand fans, these early adopters will travel like
absolutely
really, 15, 20, 30 miles sometimes, depending on, how much of a fan they are. To kind of come into these locations. Now you can't rely on that traffic forever and ever. You have to kind of get the lift from like the people that are just discovering you. So you want not only your current customers, but your customers that should be customers but aren't yet, right? So your future customers.
I also think on the tail into this one too is that similar to how they invest money in online advertising, there's a lot now done by algorithms, but effectively there's a lot of audience matching, right? Lookalikes.
Yeah.
So to the extent, like as much as I'd say, here's the demographics, I'd actually be asking them, tell me about your different types of customer segments. Who are they? What do they do? And find some ancillary examples to that. A bit earlier, about 30 seconds ago, I just wanted to do a double extra credit on this idea of traffic and footfall and conversion. In my experience, it would be helpful to fill that void of uncertainty with just a simple pro forma, just a best practice. Conversion would be this. You should expect, if you're in apparel, that your payroll may be X% of your sales. This is some benchmarks in sales per square foot and your costs. Because keep in mind that for the people that I've worked with, they're very good students of their business, right? When you talk about their funnel, when you talk about all the activity, it's a very data-driven exercise. Giving them that tool to just understand a baseline of how this works could be really helpful and rid some of the anxiety that they may have about a two-year lease, which we all kind of chuckle about but to them is a big deal.
So true.
Yeah. And
a good
so
point.
I'm gonna interject on 2 points here. Number one, you mentioned, Rebecca, that something that our crowd may not like, which is how can I get out of this? See, this is just, again, another example of how real estate is getting this wrong.
Yeah.
Are you building your property value? Or are you building your income today? Okay. You're going to have to think of it as free rent. Think of whatever you want. Think of it as TI doll. Think of it as a marketing budget. But at the end of the day, if a tenant is not doing sales, you need to get rid of them.
Yeah.
You could replace them. So there's 1.7 million brands in Shopify alone in the US, right? You should be cycling these guys. If those guys are not realizing sales, you should have a kick out on your end, for crying out loud. You
Yeah,
want
it's
to bring
true.
people in. You want to get you. It's like if you have a store. Let's think about it. I'm Kroger, right? And I put you on a shelf. It costs me money to have that shelf operational. You're not generating sales. You're out. I'm selling it back to you, right? Or you're paying me or whatever the chargebacks, right? The point is you need to merchandise your shopping center, and you need to be hands-on, and you cannot just be, hey, I'm a financial analyst. I have a shopping center because there's 130,000 cars this way, 25,000 cars this way. We got 2 means of ingress and regress. We got 2 traffic lights, and we're co-tenants with Kroger, so therefore everything will be good. No, it's not good. You need to find the right tenants, because you know what? If you're going to put the wrong tenant in there, they won't do any sales. You wasted your time in the building, wasted your time on everything. And you know what? It's an art. It's not a science. So that's number one. Number two, what Ryan just said. Here's how things are measured online. They're measured with impressions, click-throughs, and conversions, right? It's very easy using Placer AI or there's a few other companies today to figure out how much traffic goes into every shopping center. It's also relatively easy to figure out how much of the traffic passes in front of a store. Those are called impressions. You pay online for impressions. In a shopping center, you have a fixed cost of impressions, which is the rent you pay. Okay. Then you have click-throughs, which means the guy opened up the door and walked into your shopping center. And you know what's great? Instead of you having a pop-up in the corner, hey, can we help you? You actually have someone walk up, hi, good afternoon, how can I help you? Here's your coffee. Whatever it is that you want to do as a store, you have the ability to engage with these customers in real life. And then a conversion is when you actually do a sale. And you know what the best part is? They will come back to you to do an exchange instead of just sending back a return, more than likely. Which means your cost of that conversion, your cost of that impression, your cost of that click-through is not thrown out the second there's a return, but rather you can salvage it because you establish a personal relationship. And there are so many technologies trying to replicate what happens in real life online, when in reality you can use online to generate a real life experience and generate a customer loyalty and generate a personal relationship. And that's something that digital native brands don't understand. And that's something that brokers and landlords don't understand how to explain. And that's a key thing. And, it's something that unfortunately needs more education in the market. It's less about telling them you need retail. They know they need retail. Well, they don't. If they don't, done. Like you said, you're not convince them. But how is the question. Marketing terms, like we discussed, exactly what I said. Passive buys, impressions, click-throughs, person. Like, talk to them in their language. Say, oh, there's 2.4 million impressions on the property itself. Of that, we give you 30% of it will pass by your store. You just gave the guy a crap load of impressions. And it's like, whoa, right? Hand-holding, education, services, simple documents. Rebecca, what happens? You have a digital native. They have 5 people in the company. Everything is outsourced, and they get a 60-page lease.
They're like, what do we do with this? And I'm like, well, you should probably get a lawyer.
Yeah, and here's the tricky part. Here's the tricky part of it. And this is, guys, hello, real estate people, I'm going to let you in on a secret of the trade. Every single software license that any of these digital natives sign are long, except here's what it is. It's a 1-page with a link. You agree to terms and conditions. They don't even freaking open it. And they sign it, DocuSign, they send it back. That's the way to do it. You have your rules in there.
I do not believe you're allowed to say that.
I know. La, 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 la. I mean, look, I think that is a good point.
I didn't hear that.
the other place, because I don't negotiate leases. Occasionally I will look at a lease and give an opinion, but I am not a lawyer, nor am I a real estate broker. But I think on the like tenant criteria side, right? I have seen some 65-page tenant criteria handbooks.
If ProLogis can figure out how to make a 6-page lease, I think the shopping centers can also figure this out.
Yes.
This isn't
So
like, we can do this.
Exactly. So I think just edit it a little bit or a lot.
Yeah. I think
Especially if we're talking a 2-year deal. 2 years.
Yep.
Whatever attorney figures out how to standardize a digitally native or digital brand type of lease document, copyrights that and sends it out to every landlord out there, you're going to make a ton of dough. Like that is just somebody, there is an attorney out there. There's an attorney out there that you've got the opportunity to change the world.
I think someone's raising VC funds to do that right now, to be very frank with you. Oh,
great.
We got to figure it out.
Here's a dirty little secret. If you have a Macy's in your shopping center, you're not getting Glossier as a tenant side by side,
Nope.
right? If it's a mall, if it's an up-end mall, maybe. But Glossier is not going to go next to Macy's. And by the way, Macy's or somebody else probably has exclusive one, let them come in. And you have to make a choice between, do I want a $2 a foot Macy's for 100,000 square feet, or do I want a $30 a foot Glossier short-term lease, whatever the tenant is, right? And that's a decision you have to make. And while the financials may say Macy's has credit, bankable, Glossier doesn't. Macy's is the bigger tenant, draws more at the moment. Glossier, even in the best possible situation, not going to draw as much as Macy's. But your property, do you want it to be a Glossier property or do you want it to be a Macy's property? And can you afford to play that game? If you can't, then get out of the business. I'm sorry. Anyone?
Ooh, that was aggressive. Wow.
Hello. If you're restricted, but here's the deal. If you're restricted by legacy companies that have not innovated from advancing your property's desirability, then you've reached the peak.
No, but that's the double-edged sword in the conversation, Shlomo. Is the folks who do have the low cost basis of ownership are the ones who can actually afford to bring in these types of brands we're talking about. But they're also those who can be complacent to keep somebody because they've been there for 20 or 30 years paying rent on time, and it's easier just to stick with them, right? Like that's the double-edged sword. That is the exact owner who has the opportunity to capitalize on changing the way we look at retail or bringing in a hub for these types of brands. But that getting away
from you're not out ahead of it.
What they've done.
Jessica, if you're not out ahead of it, it'll eat you alive because by the time you wake up.
No, they're already, I mean, this is the mall issue, right? Like, look at our malls. Why are our malls all suffering and getting torn down and turned into distribution warehouse? Why is ProLogis?
Because we're getting calls added to your local mall. That's why.
Yeah, like it's because all these owners sat on pretty low land basis, and the ones who weren't sitting on low land basis already lost their dang malls. That happened back in 2020 and 21, and even before that, there were already malls that were going bankrupt. But even the malls that were okay positioned coming into 2020 are now not okay positioned because they were okay with the tenancy they had and weren't willing to start looking at what is retail of the future looking like. And so the complacency is what got malls to exactly where they are right now. And so you're asking a whole industry to up and change. And as we know, real estate is not that industry that knows how to turn on a dime or turn really at all. And so it's really bite-sized chunks that you have to take off here of, if you're a landlord or you're an owner and you're going, hey, how do I get long-term viability out of my particular project? The first question is, well, who can my tenants be? Who am I missing out here, right? And then, am I desirable for those brands? Because it goes both ways. You may want them, but they may not want you. And so that's where the deep analysis as an owner has to come into play and say, okay, well, I do want viability, but is this the right route for me in viability? It may not work because you could be too far off. You could be too suburban. Your product maybe is these long bay depths. Maybe you have like 90-foot bay depths. That's not going to work for a digitally native
Yeah.
brand. They want like shallow bay depths, right? So this isn't applicable to the industry at large. We're talking a very small segment, but this very small segment could absolutely change the way retail is thought about. And it changes the position of retail for the next 20 years and how people shop. And it actually is what is going to spur the rest of the industry forward. So while this may be a very subset, the impression that this puts on the rest of the retail world, which is getting out of this dogma of like, oh, the Amazon effect, everybody's going down and we don't need more retail and retail is dead. We're already seeing that that's totally not true. But if we can get this subset, this 10% to buy in and make some progress towards these brands, I think it's going to change the way that we look at retail and we underwrite retail, we perform a retail, and we develop retail going forward. And that's why this is so important right now, because this is what's structurally going to change retail going forward, physical retail.
It's a good point.
I'm sorry. I was just going to throw like, why are we the first guys to like actually present a presentation like this? Like, I just don't understand this.
Maybe we've had
Continue, Rebecca. I'm sorry.
30,000 other people have already done it. I don't know, because we're too busy.
No, I haven't seen. Maybe they have, but we haven't seen it.
Maybe
Okay,
there
Rebecca,
are other presentations. I guess so. Jessica, I think what I would love to see, because you mentioned Macy's, and at one time, Macy's was a very desirable traffic driver, because
absolutely.
it has, of course, because it has all of the things that a person could possibly want, right? It has apparel, it has, I don't know, does it have tires yet? Sears does, I don't remember, but like, it has beauty, it has apparel, it has XYZ home goods, throw all of the things in there.
It was speaking to our old Kmart roots. That's what it was.
Right. Yes.
Really
no, I loved Kmart growing up.
Strings. Just come
growing
on
up in suburbia, Kmart was like the place. Anyway, but I think if landlords can actually take that same mindset of like, I need an anchor, but what if your anchor wasn't one retailer? What if it was a collection of brands that service the customer in the same way that retailer does? So you get your Glossier for beauty, and you get your Allbirds for shoes, and you get your Outdoor Voices for athleisure, and your Jenny Kane for apparel, and your Roan for the men, and your, like, what if now this is your anchor, and your anchor is no longer one 50,000 square foot or whatever those things are, like however big they are. Like, what if it's the conglomerate?
That is so much safer than having one guy who can one shop, one place that can literally go dark and boom, you have no traffic. You got nobody there. I mean,
it's true. Because guess what? If Roan goes belly up, and they won't, I love those guys. I actually know them. But then, like, Mack Weldon can come in. Like, okay, no problem. Just swap them out. It's like Legos, right? Like, now you're doing like a Lego exercise with your mall.
Yep.
Feels a lot smarter and mitigates a lot of risk on both sides.
Absolutely.
Yeah, I think, listen, and at the end of the day, it's just important to move things forward, because what you're leasing is not a tenant. You're not leasing to a tenant for 2 years or 3 years or 5 years. You're actually leasing space to a shopper every single day. And they have to have a reason to come back. And you, as a shopping center owner, need to help those who don't understand how to bring shoppers into stores, bring those shoppers into your shopping center. And if you have the proper traffic, then you can actually do something with it. But if you don't, then you're just going to be, you'll just go the way of the, the main drag has moved.
Like the other 90% of retail.
Yeah. So, I mean, we'll just, we have maybe one more slide over here, just go through it. So how are you progressive landlord? First off, to quote my friend Will O'Donnell, we lease to them for 5 years, and we forget for the 5 years where these guys are. They're there the whole time. Provide services. They need the services. They need the help. You can charge for it, make money, right? Number one, concierge. Help them set up. Deal with Rebecca. Rebecca advises them what to do. But you need someone on the other side to be able to sort of, work with them. Turnkey spaces. We spoke about that. Spec suites, right? The stuff leasing today is spec suites in office. Make spec suites in retail. I know that, so you may get a restaurant, may not, but there's plenty of restaurant second generation space that you could back those into, right? At least make a spec suite that's Not for restaurant. The worst case, you spend $50 a foot. It is what it is. It's an investment, but you could get these guys in if you give the right deal. Here's another one: measurement and attribution. The brand needs to understand, what does this traffic and retail business do for my greater business, right? How do I attribute a shopper in the store to what's going on online? And that's something that a lot of people are working on. It's not something that's clearly available, but if you can figure that out, then that's positive. Digitization. How do you digitize in store the same way you digitize online? And fulfillment and returns, it's a big pressure point. How do you solve fulfillment and returns? These are at least 6 ways that we've been able to come up with, and I'm sure we all have some additional ideas now, how you could be a progressive landlord, how you could be more than just like, oh, talk to my leasing guy. Okay, you signed the deal. I'll get back to you when I get back to you.
I want to share a thought on the motive. When I was a young, eager beaver, and I had my first conversation with Don Fisher, the founder of Gap, and of course I was like trying to get into the wisdom, what's the most important thing I need? He said something that's very simple, but he just said, what I've taken away, because he used to be involved in real estate, right? And then he got into the sort of jeans and Levi's, and kind of that became Gap, was I think he said, just change or die, I think was his phrase, right? And I kind of feel like it's very relevant here for this one reason. There's already been a tectonic shift, and that shift is that new emerging brands, and by the way, all brands go through life cycles, right? Sort of adoption, interest, maturity, sort of decline. You can hang on to the old legacy 40, 50-year-old brands for only so long. Let's be honest about that one, right? But the new emerging brands that launch, that cultivate themselves, have a very strategic advantage to do it online, right? Social media, they can reach a lot of people. They can cast a really wide net. Doesn't mean that they can live there for forever, but you do have to think about how you can adapt to these types of up and coming brands in the future. It's not going to go away. And I think you're going to see a lot more of them. And by the way, there's going to be good ones like Buori. I'm sure I just mispronounced their name. And I'm totally comfortable with that. But you know what? You can tell when you go into their store that this is going to be a juggernaut, right? So they have brand equity. Do whatever you can if you were speaking to them 4 years ago to work with them, to do it. If it was 20 years ago, kind of fast forwarded today, and you saw Lululemon, you would think, my goodness, I know they don't have a lot of sophistication. Find a way to make it happen, because I think this is going to be the new norm in the future.
Yeah, I kind of try to attribute this. When I started my career, I started in office space actually in the Bay Area and biotech. And we would literally go pick I call them kids, people off campus at Berkeley. And we would go do tours for 20,000 square feet. Well, started would be like 2,000 square feet of lab space. Well, the next thing you know, it's 5 years later, they've now gotten their funding, and now we're out for 200,000 square feet. Same kids that had their backpacks on 2 or 3 years ago that you're picking up off Berkeley's campus. This has been going on in office space, biotech space, even industrial to some degree for years and years and years. But no one's bought in on the retail side, which I find very interesting. This isn't anything new. This is something that's been going on within commercial real estate for a very long time. Again, it comes down to that mind shift that retail's always had these blinders on. The owners are like, well, it's for your specific type of use. You do you, pay me my triple nets, my rent, and I'll just be over here. And I think that's the cycle that we have to start getting away from, because in every other aspect of commercial real estate, we see landlords investing in their tenants. Look at Prologis. They have a whole side that is just for building out ventures for integrating into industrial, whether it's from how trucks make it into sites. If trucks are electric, they have a whole approach of how do we help our tenants so that our tenants stay with us and grow with us. But yet somehow retail has gotten in this place of like, well, we don't need to do that. And I think we've got to stop that mentality, because that's what's killing retail. It's not Amazon. It's that type of thinking.
Yeah, I would agree with you. Is that, well, of course I agree with you on everything you say, that's for sure. But
So
I think retail.
You must have.
Sorry.
What did you have for breakfast this morning? Did you have some Wheaties? You're in a good mood. I like this.
I'm always in a good mood. Always in a good mood. I have my good mood costume on. But so I don't think retail is dying. I think retail was being killed by some in the industry, and it has been resilient and recovered, and will continue to recover despite the best efforts of some people to harken back to old days that don't necessarily work. But I do want to dig in here on one question that was thrown out here. Tushar Desai, I hope I'm pronouncing that name properly. What's the ideal comparison for monthly rent space plus shelf holding costs versus Facebook advertising costs? So I think I'll let the floor take this, but I'll obviously give my 2 cents like I do on everything. So I don't know if it's as much self-holding cost if you're fulfilling e-commerce from the same stock necessarily, but it does. If you're not, then there is a shelf-holding cost, and then the question is, can your e-commerce people get it? But other than that, Facebook advertising costs, the question is, what do you get from Facebook advertising? And we spoke about the impressions, click-throughs, and conversions. And just when you project out your sales and project out traffic, that may be a good way to look at it. But I don't know if anyone else wants to take this and dig in on it at all.
Could you repeat the question again, just so I'm clear?
What's the ideal comparison for monthly rental space plus shelf holding cost versus Facebook advertisement cost?
I think if I understand the question correctly, I would sort of go the simple answer, which is this. It's just look at the unit economics, right? So you put X amount of dollars into a Facebook ad, maybe you've sort of optimized your creative, your audience, your targeting, etc., and you're getting the best out of you can. So how much are you putting in and what are you getting out of it, right? You pure unit economics, and then just flip it on the other side, right? Like Shlomo and I, we've done a gazillion comparative models on this. And ultimately, I think that's where you might find a good answer, at least a direction to say, interesting, I can do X amount of volume over here. This is the model. This is what comes out as a result of these input costs. And this is what I benefit in terms of tactical sort of consumer engagement, sales, and return visits, etc.
Okay. Anybody else want to add in on that? Otherwise, we're going to wrap here, unless anyone else has any questions.
I got my rant out already.
Yeah. Me too.
Right. Okay, so this one ran longer. We went to hour and 20 minutes here. So I want to thank our esteemed panel. So this will be posted via a more refined video with better subtitles than what LinkedIn just does on the fly, because it's very hard to hear what I have to say and put that properly into LinkedIn. Loses impact, I think, is what it is. But that being said, we'll post this as a video. We'll post this as a blog post, and we'll also post this as a podcast. So thank you so much as usual. And if you will be at ICSC, Ryan and I and Jessica will be at ICSC too. Great.
Be at ICSC. Yep.
Great. So make sure
the floor.
make sure to seek us out.
Yeah.
Yes, because we're I guess celebrities now.
Come say hi.
Yes. Jessica's cell phone number is you can you can find it on the Lean Associates website if you really, really need it.
Yeah.
Okay, great. So thank you so much, guys, and have yourselves a great Tuesday.
Bye.
Bye.